Hi, I'm Cody from Wall Street Breakdown. You know, we've been going over a lot of stuff, me and you. We've really been taking care of a lot of the particulars when it comes to you getting started investing your money. Now, no matter what that ends up being in the long run or how you decide to diversify your portfolio, the principles still end up remaining the same. And that's what we've been covering a lot more recently, is really getting into the nuts and bolts, the actual, the overlay of the market, what that means to everybody, exactly what these numbers are. How can I put any of this to use? It all just sounds like Japanese to me, and I assure you, a lot of the times when something's new, that's going to happen. What we're talking about today is the trailing price to earnings metric. That's right. Probably a number you're going to see quite a bit. Now, when we're talking about trailing price to earnings, you can also lump in just generic price to earnings, because that's going to be easily the most quoted PE number. So whenever you hear price to earnings, PE ratio, you can assume that they are talking about the trailing price to earnings of that specific company. This is going to be a metric that's used all the time. Pretty much one of your go-tos. Everybody's going to be using this for some purpose, right? You might not be basing all your decisions off just your PE ratio, but it is a ratio that is going to make it in to all of your fundamental analysis, that I can assure you of. So, trailing PE or PE ratio, what do we think that means? Like the sheet said, we're talking about, not my left, we're talking about the past. This is the past, my friend. We are no longer thinking about the future, as we're relishing in the past, hopefully, with a decent PE ratio. Maybe it was a bargain. Maybe you guys made a grip of money, but the fact of the matter is that the past is what we're talking about. So please remember, past results are not indicative of future performance. Trailing PE is calculated the same way forward PE is calculated. Current price divided by 12 months EPS. In this case, we're talking the 12 previous months trailing price to earnings, right? So we're talking about 4 quarters of EPS removed from the date and time that we stand at, divided by, over top of it, the current stock price. So if you had a stock price of 50, let's say, and your previous 12 months EPS was 50 cents a quarter, so you made $2 EPS in the past 12 months, trailing 12 months, if you will. That would mean that 50 divided by 2 is going to give you a trailing price to earnings ratio of 25. Is that good or is that bad? I really have no idea. It's all really relative to the stock that you're looking at, but the fact is that a PE ratio can definitely help give you a little extra nudge in a certain direction, deciding on whether something might be a bargain or whether something might be maybe a little too overpriced. See, now the PE ratio is good for comparison's sake. You can not only compare it through the competition of the company that you're looking at. See, a company whose price to earnings might be a little bit higher, it might be higher for a reason. So when you're comparing two companies and you look, okay, this company has a price to earnings of 19. This company has a price to earnings of 25. The balance of the sector, the average of the major companies in the sector, all average out around, let's say, that 19 number again. So now you're thinking that 25 company, they're paying a lot of money for the same dollar of earnings. They're paying a lot more than they are for the balance of the sector, but there could be some other factors in that. So don't just write it off as being what it is, because that company could be doing things on a much more exponential level than these other companies you're comparing it to. If you don't know what's actually going on inside each of these companies, company at 25 trailing price to earnings might be a company that's got a lot of growth prospects. And the companies that are already in the sector trading around the 19 price to earnings mark, which seems to be the average for the sector in this example, they might just be your regular old blue chip companies. Now, there's nothing wrong with that, obviously, very stable, but you're not going to get a price to earnings that gets well out of range of the sector, or else that company will easily be overpriced. So you're comparing it with your competition, the sector, and the market, for that matter, entirely, because it's going to let you know, and you do have ranges. Let me say this right now. Like, there's a range for sure. For every sector, you're going to see a range, and you're going to have outliers, obviously. But for the most part, with relatively established business, you are going to have a pretty decent PE range that you want to see companies in a sector fall into. Now, low PE in comparison to a sector could be a bargain, but could be a reason for that, as we could be talking about in the next video, forward price to earnings being way off compared to a trailing price to earnings, but we'll get to that. But there could be many reasons. So you may be looking at a bargain, if in an example that we were giving where the sector's around 19, maybe you have a company trading at 15. Why are people paying so little for the dollar of earnings in comparison to their competitors? It might be that this company is a bargain and it's worth you looking further into it, but it might also be that that company's future prospects aren't near as good as these other companies, and that company ends up just trading a lot less because people just are a little more trepidatious as to putting money for every dollar of EPS they get back out into a company like that. So, again, you're going to have outliers in the other direction. There are some notorious cases of price to earnings numbers that will knock you on your ass. I mean, you're going to look at it and you're going to say, how is a company valued so drastically high? But a lot of the times it comes in the place of having no real competition. When there isn't anybody else that's going to be able to really tread on your toes too much, your company can start to grow fairly exponentially on ultimately what they assume you're going to do in the future. And that price gets drummed up because everybody wants to be in on the ground floor. We have a lot of examples of that, depending on when you're watching this. But I mean, if you go back in history, take a look, Amazon notoriously had a high price to earnings because the future was bright. The future was always bright. So the stock price was very high in relation to the EPS number. But Amazon's growth potential was able to be seen for a bit. I mean, you can see it, but you couldn't tell me that you knew Amazon was going to get into Whole Foods and all that, but that's another story entirely. But you could see what they were doing, and prosperity was definitely on the horizon for the company in an exponential way compared to almost anybody else in any other market, in any other sector. So was the growth going to be there? People assumed it was. And price to earnings for a decade or more were way ridiculously high, to the point where when you looked at it, you almost had to become fearful of getting invested in something where it seemed like the only thing that could happen was a correction. But that's not the case. You see it also with companies like Netflix or with Tesla, because they own a marketplace or they're a burgeoning technology. And when those things start to take hold, you will have wanted to have been on the ground floor. What can we say about all those companies? Netflix, Amazon, Tesla, they've all had significant runs to the upside. The upside's a nice side to be at, but if you were using that price to earnings metric as your only metric for investing, you'd be well scared off. So you have to just remain cognizant of the fact that the price to earnings could be showing a bargain, could be showing something that's way overpriced, but it might just be another metric in the basket of metrics you're going to be using doing fundamental analysis. You got to remember again, like I was saying, this is showing you the past. The past is not going to tell you what's going to happen tomorrow. And we're investing tomorrow. We're not investing in the past. So you need to just remember that when you're looking at trailing price to earnings, or a PE ratio, all going to be the same thing. That jargon, don't let it throw you off. If you need to watch this video a couple times or do a little bit of reading, please, once you get this down, you're not going to have to do it again. This is what you're going to learn. This is one of the key metrics in the entire capital markets Once you have this down, you're going to be able to understand this and use this practically. Whether you're using it in your own research, in a conversation, explaining it to someone else, it doesn't make a difference. You're going to understand one of the very key metrics used in the stock market. And it's a very easy metric to understand. Very easy. Like we were saying, current price divided by, in the trailing price to earnings example, the previous 12 months EPS is going to give you a range. You're going to be able to see exactly where that stock sits in comparison to a lot of its competitors, in comparison to the market. But please take into consideration that A, it is the past, and B, there are a lot other factors that are going to determine why a stock's price is what it is. But the PE ratio is a good way of getting started, doing some fundamental analysis, and always interesting just to know how everything works, right? We don't want to just have ourselves fixed to one type of investing idea. The best thing to do is take advantage of all the different metrics out there, understand which ones you like the best, and use that in your basket of fundamental analysis. I'm Cody from Wall Street Breakdown. This was trailing price to earnings, or your PE ratio. Have yourself an outstanding day.